Hello, I'm Ernie Humphrey, the CEO of Treasury Careers. I'd like to thank everyone for taking the time to join us for our webinar today, Effective Cash Flow Forecasting, Working Capital, Business Intelligence, and Strategic Agility. I would like to thank our webinar partner, Centage, whose strong commitment to thought leadership helps us make this webinar possible today. Cash is the lifeblood of your organization. Your ability to produce accurate and timely cash flow statements and to perform analysis based on those accurate and up-to-date reports is highly critical for assessing both the current health of your organization and making key business decisions. Knowing the timing, amount, and predictability of future cash flows should be an essential component of the budgeting and planning process at all companies, not just high growth and highly leveraged companies. However, because modeling payables and receivables is so difficult, using spreadsheets, an accurate cash flow picture still eludes most organizations. The good news is that companies are now leveraging cost-effective technology that offers a formula-free solution for cash forecasting that leverages built-in business and financial intelligence. Today, you will discover the mechanics, challenges, and benefits of forecasting your company's free cash flow and learn how effective cash flow forecasting can offer your company key business intelligence that improves financial planning, fuels strategic agility, and empowers better working capital decision making. Before I delve into the content today, I'm going to offer a few quick words about Treasury Careers, cover a few housekeeping items, and then I'm going to review our learning objectives as they are the pillars of our value proposition to you in investing your valuable time with us today. Treasury Careers offers content and resources that empower Treasury professionals to own their career success. I encourage you to visit us at treasurycareers.com. Now, our exciting housekeeping items. For those of you interested in receiving CTP or FP&A credit for today's webinar, you'll have to answer all of our polling questions and remain on for the duration of the webinar. If you have any questions on CTP or FP&A credit, please send an email to Ernie@360thoughtleadership.com. Again, that's Ernie@360thoughtleadership.com. I'd like to hear from you during the webinar today. So I would love to have your questions in the Q&A section of your GoToWebinar control panel at any time during the webinar today. Fear not, if I do not get to your question during the Q&A session at the end of the webinar, I will reach out to you directly to answer your question. Finally, we appreciate your consideration in taking a short survey at the end of the webinar today, as we always strive to improve the ROI we offer our event attendees for their valuable time. So our value proposition for you today. After attending the webinar, I'd like you to be able to have a better understanding of the dimensions of effective cash flow forecasting, assess the current state of your cash forecasting efforts, define cash flow forecasting success for your company, identify and mitigate inherent barriers to cash flow forecasting success at your company, understand the benefits of leveraging the right technology for achieving cash flow forecasting success at your company, and revise specific areas of your cash forecasting process to improve the value realized from your company's investment in cash forecasting. So, how are we going to accomplish our objectives today? Well, we're going to set the stage here for why cash forecasting matters. Oftentimes, to unlock that strategic value is going to require an investment in people, process, and technology. So we have to be able to make that business case effectively to the CFO if we're not the CFO. We're going to talk about we're going to define a cash forecasting process and framework. We're going to teach you how to identify your cash forecasting resource needs, how to identify and mitigate inherent barriers to cash forecasting success at your company. We're going to talk about the value of investing in the right technology. We're going to share with you some cash forecasting best practices from our friends at the Association for Financial Professionals, and I'm going to offer you some closing thoughts and resources. Let me take a minute to level set the expectations for the webinar. I have experienced dozens of cash forecasting presentations as a Treasury practitioner and as a consultant, and there were times when I was disappointed. In certain cases, that may have been based on my expectations for the presentations. So let me level set expectations a bit before I delve into our content today. I'm not going to be able to fix all that is not optimal in your cash flow forecasting efforts, but You will be armed with information to assess where you're at, where you want to go, gain an understanding of what it might take to get you there, including the ROI of investing in the right technology, and make the connections you need on your journey to optimizing the strategic value of cash flow forecasting at your company. For those of you who have never heard me speak before, you'll know I like to keep things simple. Sometimes I repeat items more than once to make a point, and I like to infuse a little bit of humor around the content. One of my objectives is to make you smile today. So improving the strategic value of cash forecasting, as I mentioned, may involve an investment in technology as well as people and process. So I want us to keep in mind the value proposition of effective cash forecasting and how to make the business case for it. So here are some potential pillars of that value proposition. Cash forecasting impacts borrowing and investment decisions. It can impact debt covenant compliance risk. It impacts working capital efficiency. Uh, it also facilitates analysis into the sources and uses of cash, along with the associated costs and benefits. So as we start to look at those drivers of our cash forecast, it really gives us the incentive to really optimize those. So particularly in the areas of accounts payable and accounts receivable. So as we look at the drivers in those areas, it gives us the motivation to look at that. And then as we start to optimize the visibility and the forecast that we get from accounts payable and accounts receivable, guess what? Our company is in the process going to become best in class in accounts payable and accounts receivable. We're going to realize lower cost in AP and AR. We're going to potentially improve customer and supplier relationships. So as we start to look at cash forecasting, I'm going to really kind of blow things up a little bit because effective cash forecasting has so many benefits. And part of the benefits that we'll talk about are the benefits to the FP&A efforts at anyone's company and the strategic value of FP&A. Cash forecasting impacts your financial agility. Done right and done in a timely manner, it can allow you to anticipate and react effectively to dynamics in market conditions. It impacts your operational agility. That good cash flow forecast can really give you a sense of where your borrowing needs might be, how much cash you have on hand to capitalize on maybe M&A acquisition activities. So it really gives us that agility, which is a competitive advantage. And also there's an increased focus on cash balances and cash deployment efficiency in the markets. And another reason that I think that is once again becoming getting this focus is just the advances in technology and really the increased visibility that we're now able to have into the drivers of cash forecasts, which might not have been so easy to come by in the past. So all these things are really driving why there's much more focus on cash forecasting in today's world. I love this cash forecasting process. So there's probably 3 levels of you in the audience. Those of you who are just kind of maybe beginning, newer to Treasury, maybe a CFO to a new company, you're not familiar with the cash forecasting process. Those of you who are experienced, someone experienced, you may be using Excel. You've been hearing about all this new technology. I've been hearing about cash flow forecast, free cash flow forecasting. What is it that I can learn from the webinar? And then there's other of you that are on the forefront who probably know more than I do about cash flow forecasting. You just want to make sure that you're up to speed on the latest and greatest technology and extracting all the benefits to your objectives. So I'm going to try and hit all 3 of those segments today. So those of you on the right spectrum, I'm going to go through some basics, but I always find that even if you're really advanced, it's really good to sometimes sit down and take a look at your process, how it developed, and also it can be beneficial to share some of this information. Those of you on your staff, maybe those are new to your company who are going to be stake owners in the process. So I love this diagram from my friend. I'm Tim Hessler. Once I find something, I use it, and I haven't found anything better from the 2009 AFP annual conference. Again, the steps, you need to define your business objectives. So what you identify and prioritize your cash forecasting and liquidity management objectives. I still find that some of the Treasury professionals I speak with, they don't really seem to have a good handle on why cash forecasting. Why are they doing it? What are the benefits of it? what is the impact that it's going to have? Am I impacting decisions? How am I improving my working capital? So what's that cost benefit analysis? You need to look at your requirements, clearly establish the goals of your cash forecast, and then your techniques, your analysis, understand your current business factors and your forecasting drivers. We'll spend some time there. You want to look at your design. You want to go see direct or indirect, see how low do you want to go in terms of that detail. And then you need to look at establish the required support and then an implementation plan for activities and ensure that accountability, and then create that process for continuous improvement. So I love this kind of end-to-end process, and we're going to go through this today. So one of the key parts of that will be where are you at, where do you want to go, and what's it going to take to get you there, as well as talk about some of the basic mechanics, but then also talk about some of the advances in cost-effective technology, which are really game changers in terms of the value that can be realized from effective cash flow forecasting. So let's talk about setting the stage for an effective cash flow forecast. Again, this seems basic, but again, sometimes people, they have so many things going on, they kind of miss the blocking and tackling. So you need to identify the type of the forecast. Is it operational, 1 to 30 days, a short-term, medium, long-term? And then you need to define the goals of the forecast, which is tremendously important. Manage your short-term borrowings, tie to your balance sheet forecasting, manage your capital structure, and then you have to look at what's your desired level of accuracy, the goals of your forecast. So what is the percentage of being off that is going to impact your decisions? So I think these are just key things to take a look at in terms of in doing that assessment of your forecasting efforts. Take that step back, and some of the variables and processes may change depending on the type of the forecast that you're looking for at your company. So let's take a look at free cash flow forecasting, a quick overview. So cash flow free is a forecast of cash available after your company funds, your costs, accounts receivable, capital expenditures, and inventory. And I think it's good because it's an indicator of business agility and resource deployment efficiency. And then in terms of the mechanics of the free cash flow forecast, it's calculated as operating cash flow minus the capital expenditures. And then what you'll see throughout the presentation as we start to go through the cash flow forecast models is you'll see references to a presentation, Cash Forecasting, a Free Cash Flow Perspective, from the 2017 AFP Annual Conference. There is a link there, a great wealth of information. Later on, I love the framework. I'll identify the individuals who provided the framework later, but I love the framework that they set out. So that's going to be the basis for some of our content, and I really think it's incredibly a valuable framework and a way to couch things in order to look at your cash flow forecasting or cash forecasting efforts. And so one of the other things that really catches my eye and why this is important again is I mentioned that we have the technology available. And so here is where we're really able to dial in, and I think this is where we're able to get much better. And I think that if we look at some of the drivers of ineffective cash flow forecasting, maybe in terms of accuracy, they would have come from some of them from changes in working capital. We have much more visibility into that part of it as well. And then assuming that we have good communication from our operations folks, the CapEx side of the business wouldn't have been too much. And then as we are in Treasury, hopefully we would have been involved in the investment decisions and incomes. So I see really where the technology is really going to allow us to offer value and really increase the accuracy and value that we extract is really getting these changes in working capital, and of course the other ones as well. But I think this is where we're really going to see that value, and this is where companies should really put their efforts. And then again, I mentioned that diving in, understanding your working capital is only going to drive your efficiency, and it's going to allow you to own your cash conversion cycle, which is tremendously exciting in today's world. So why use the free cash flow forecasting method. Why are we seeing that? This is an increased focus of investors. So folks view it as a clear measure of financial performance. Again, cash you generating, how much cash do you have? It's an indicator of strategic agility, right? How much cash do you have on hand? How much are you going to have on hand in order to respond to dynamics in market conditions, some opportunities that come? It gives you a more informed capital structure. You can see the cash impacts, and so you can also see, are there opportunities to optimize our capital structure based on the cash we have available, and dividends and things of that sort as well. And then technology allows greater visibility into cash inflows, cash outflows, and also our business operations as well. So in addition to what we would see in Treasury traditionally, ERP, our banking systems, were also these customer relationship management systems are also giving us great visibility, insights into our sales forecast, the health of our sales forecast, which is a key component on the receipts side as well, and can also help us improve our customer relationships. So I'm going to go ahead and launch our first polling question, because I think I always say you can't manage what you can't see. And so obviously a key component of effective cash flow forecasting is the visibility of cash balances and movements at your company. So I think that is obviously an initial step and something to have an assessment of. Like, of course, from a Treasury perspective, we think of that. Are we able to see into our bank accounts, the visibility in our bank accounts? And then from an ERP perspective, are we seeing how those changes in bank accounts are affecting other items, and how does that translate to our forecast of our financial statements? Just a reminder, those of you who might be interested in CTP or FP&A credit, I need you to stay on with me and answer all the polling questions here today. Of course, I appreciate everyone's consideration in answering all of our polling questions here today. And I'm going to go ahead and leave the polling question up for another 5 seconds or so. Then we're going to take a quick look at the results, and then we're going to take a look at the cash flow forecasting framework I mentioned, which is courtesy of John Covey and Manan Kuwadia of PwC. So let's go ahead and close the poll, and let's go ahead and take a look. So let's see. So we've got 20% of you in somewhat limited and limited. So I'd say you might be a little bit farther to the left in that spectrum. And so that's really key, and that's a tremendous inherent barrier. So without the ability to really understand those cash flows, it's going to be hard for you to really deliver value from that. Good in places, still have blind spots. So good to see that. And the good thing is that you know you have those blind spots, and then part of taking your next step on the journey is to recognize, okay, we have these blind spots. Now, is there technology out there? Is there any way for us to improve our supposed to be blind spots, not blonde spots? I do have blonde spots because I have blonde hair. Sorry, I had to have some humor in there. So blonde spots, and then 4% of you have that 20/20 vision. So I'm happy that congratulations to you. So that's obviously key in driving success at your company as well. So thank you very much, everyone, for your consideration in answering the polling question. So let's take a look at the cash flow forecasting framework. Again, courtesy of John Covey and Manan Kuwadia of PwC. They gave a great session at the 2000 AFP annual conference. Again, I have the link there. So I like this for many reasons. In the center, we have a focus on whether we use that direct or indirect model. But then in the four-corner approach, what we see are things that really impact cash forecasting success. Up to the left, we have our drivers. Do we understand what our cash flow drivers are? Do we have visibility into our cash flow drivers? What is our process in putting our forecast together? Data. What are the data and tools that we're using? Do we have the right data? Do we have a timeliness of data? What kind of tools do we have in place? What kind of technology do we have? Do we have the right systems? Do we have one version of the truth? Do we have disparate systems? Our metrics, and I would go over here because I like to talk about the people, because a lot of times on the metric side, the people involved in the process, we're going to want to leverage KPIs of those who might own pieces of our forecast to incentivize them. So looking at behavior of our organization, that's really, in some sense, it gets down to whether it's a centralized or decentralized process. And then once we identify those key cash flow drivers, who has ownership of those drivers, and then who below them may offer those inputs, and then is it that owner who's going to have their ultimate responsibility for delivering that piece of the forecast, which is going to be then consolidated to that aggregate forecast. And then the metrics of reporting are really kind of what help us determine the value of our forecast, but also helps us move in the right direction. And we'll talk about all these individual pieces. But again, if I was to look at, a way to look at this cash flow forecasting framework, and you can get a really comprehensive view on one slide and take a look at what really impacts cash forecasting success, this would be a slide I would use, and this would be a framework that I would encourage you to use in doing your assessment as well. So let's go ahead and talk about the methods. Like I said in the middle, all of you are probably pretty familiar with this. We have the indirect model method, top-down, often derived from the P&L and balance sheet forecast, offers more of a macro view. So it looks at the top, and then you transpose down to the business units. It's better for a medium or long-term horizon. Then you've got the direct model, which is that bottom-up micro view by unit, product lines within business unit cost center. How low do you want to go? It gives us, we have detailed projections of receipts and disbursements. And then implementation requires more time and resources, but I would say that the time and resources has gone down quite a bit in the last few years. And given the advances in technology that we've seen, this is really the model that I prefer as a former Treasury practitioner, just because how low you go, and you can really get into the drivers and really dive into the details and really understand not only the dynamics of the drivers, but also the interrelationships between the drivers. So that visibility and the analytical tools that we have now, I think would really point me towards a direct model. Of course, if I'm going out longer, I might look at the indirect model or a hybrid approach, but for me, given the advances in technology, I would have a preference for a direct model. That being said, I'm going to focus on looking at a direct model. And in a previous webinar that we've done, we've taken a look at an indirect model. So if you're interested in seeing more of the indirect model focus, go ahead and reach out to me and send me an email, and I'm happy to send you a link to the webinar recording there. So those are the methods. So now let's take a look at the methodology, which first of all, let's talk about time horizon. Can generally be up to 3 months by week or by day, and sometimes people do that almost in real time. The frequency can be updated bi-weekly, weekly, daily, and depending on where data is coming from, where it's being fed. That can also, in some cases, be updated almost on instantaneous data. Real high-level methodology, estimate the amounts and timing of your inflows and outflows, really leveraging your transactional data, your outstanding AR, outstanding AP, and corresponding receipt payments, types and terms and patterns as well. And so those I would say are really your knowns, and then you're going to predict cash flow drivers that might not be able to be forecasted effectively using data, using statistical analysis or trend analysis. So those could be what we would call macroeconomic variables or endogenous variables. So those might be things that we might use to examine. Let's say we're at a motor manufacturer, weather might be something, or we might need to look at foreign exchange rates in that way. So in terms of drivers and process, cash flow drivers, very high level, but just to put some framework on there. receipts, collections, disbursement, spend, intercompany, and then payroll and benefits. Tax and payments and refunds, hopefully those are known, but the information in order to come up with those is really going to come from this side. And then endogenous factors, which are weather and FX rates. And what I'll focus on when I'm talking in terms of technology is we'll focus on drivers, receipts, collections, disbursement, spend, and then payroll and the benefit payments. And then, as I mentioned before, as we drill into cash flow forecasting, how to be more effective in that, how to increase the visibility here into the mechanics, we start to ask questions, how things are done, why things are done, what does this do? This facilitates AR best practices, impacts the bottom line. Disbursements, how are we spending money? How are we making payments? AP excellence. And then payroll and benefits around our employees, the processes. So you start to look at the cost benefits of these. So in looking at how to accurately forecast these things, as we start to look, it's almost as if we're putting our glasses on and we start to identify opportunities to offer value when we're going through this process of cash flow forecasting. And then effective cash flow forecasting, it might be the case, hey, if we tweak something in our AR process, it's going to give us a better forecast of AR to use in our forecast and analysis. Hey, look at this on the payment side. If we start to use virtual cards, that might give us more control over that spend. What if we start writing checks? So there's tremendous benefits here. But you want to make sure that you understand these drivers. And another point is these drivers can change. So you want to make sure that these drivers, that you validate these drivers. And then if your business model changes, you do an acquisition, you're going across borders, these things may change. So you want to make sure that you are constantly validating those factors as well. And so again, just in determining your drivers, I like to note you can't identify what you can't see. So you really need to look to optimize visibility relative to the variables that are or could be your cash flow drivers. And then also, and again, that'll incent you to give more attention to the underlying business processes. And then again, very, very high level process, receipts, payment, forecast. You may have some ownership, decentralized, consolidation, and then we'll want to look at that variance analysis, look at the actuals versus our forecast, and then we'll start to want to look at what are the causes of that variance analysis, and we'll want to look at the causes, things we can control, things we can't control, and then things that we can control. How much do I invest to lower that variance? And then what is the value to me in increasing that percentage? Does it improve my decision making, relevant decision making? And then we want to have this be a continual process, learn and improve. And then in terms of variance analysis, we all know, some of us, especially who are in Treasury, when you're looking at variance analysis, you want to look at both what I'd call a positive and negative variance. If you're looking at FX rates, if you get something in the forecast and the currency moves a certain way, it can make you look better. And if it moves, so just because it makes you look better on your financial statements doesn't necessarily mean that it's better in terms of a risk perspective. So you want to understand, the volatility itself, positive and negative. And in many cases, the goal is going to be to minimize that variances. I actually was chastised on just because there was too big of a gain loss for us in our income statement. So let's go ahead and launch our next polling question. And I'm going to asking you to share with us to characterize your understanding of key drivers of cash forecasting accuracy. Again, this is obviously another pillar, so that visibility is the first step. And then, okay, how would I characterize my company's understanding of the drivers? If it's not where you want it to be, how do you improve that understanding? What type of data, what type of process, what types of conversations maybe you need to have conversations with people beyond finance, across borders. And so what do you need to do to understand the key drivers of your cash forecasting accuracy? And obviously, you want to make sure that if you assign ownership of a key driver, that they understand that as well. So I just want to remind everyone who are interested in CTP and FP&A credits that we need to have you answer our polling questions. Also, want to remind you that I can take your questions in the questions area of your GoToWebinar control panel. Just because we've had multiple questions here, I am happy to share the presentation with you if you send me an email to Ernie@360thoughtleadership.com. I stopped putting those in the handouts area because people were having trouble downloading them. So please go ahead and reach out to me and I'll be happy to share that with you. So let me go ahead and close the polling questions and take a look here. And we see that we have 43% limited and adequate, so in need of improvement. So that's about what I expected. Ideal under constant analysis, that's great. That's kind of where we want to go. And 44%, I'm surprised, happily surprised to see that it's becoming a key company focus. So hopefully those of you who are in the 87% limited, adequate, or good, we are going to give you an incentive to look at what technology might be out there and processes and sources of data and analytical tools that might help you really understand your key drivers of your cash flow forecasting accuracy, and I think that will certainly improve your the value that you receive from your cash flow forecasting efforts. So let me go ahead and get back to the content. So now let's look at the people process. So those of you who have listened to my webinars before, you know I like to frame things. Guess what, in terms of people, process, and technology. So this is really the people part. So a direct model is often good, requires an accountability model, and it can be based on key cash flow drivers in a decentralized cash flow forecasting environment. Just kind of for reference here, just a sample of what I've seen or how I would do things. I took the way things were laid out in the presentation that I've referenced before and made some tweaks based on my experience. But again, what you see here is the receipts, the AR, and then how does that flow up? The director of credit may own that, and then who are the input providers? So I think this is really good for you to have an understanding and also optimize this. How people are involved, why are they involved, and what technology do they have access to in order to help them in their efforts. So again, and then on the AP side, and then Treasury, and then payroll and benefits HR, and then depending on your company, this can be a little tricky. The controller side, and then your CapEx and your tax. And so again, just that consideration in that framework is your structure, decentralized or centralized framework. You can be decentralized, but you have to make sure that the processes are consistent across everyone, and if possible, you want to give folks access to the technology and analytical tools. So you want to make sure that everyone who impacts that forecast has the same resources, tools, and expertise. That your cash forecasting program lead has. And then also, obviously, it's critically important in many cases to create those incentives on those metrics. So director of credit, how far off were you on your forecast? And then we look at the variance. Maybe it's, okay, we're going to look at your top 10 customers. And then it can be soft and hard incentives. Oh, you're way off. You're way off on company C this time. Can we have a better relationship? And so some of the variance can also help us point to issues if we start digging into the variance analysis. Hey, are we having problems with our suppliers? What's going on? Why can't we figure out when our disbursements are going out? What's going on over there at AP? Hey, what's going on over there? On our sales guys, are they missing forecasts? So again, some of these things, this analysis, it really allows you to be that trusted strategic advisor across the enterprise. And again, as I go through this model, you can see why it's very enlightening to go through and look at this four-corner framework that we've started to go through today. So data. So let's look at data and tools. Data challenges obviously include data coming from disparate systems, untimely data, inaccurate data. And at the end of the day, your goal is to automate data collection and the validation or cleansing of the data. In terms of some facts, some of you will probably be well aware, some of you may not. And I'll also, later in the presentation, as we talk about, especially on technology, I will give some more color around some of the points I'm making based on a survey that I was involved in from over 300 FP&A and finance leaders across the world. As I said before, a lot of the value in effective cash forecasting can be leveraged in our FP&A efforts as well. So not surprising, Excel is still the most widely used tools. We're seeing upticks in ERP, TMS, and FP&A. And what I'll do a little bit later is I'll kind of go through some of the limitations of Excel, mostly widely known, if ERP and even a TMS and some BI tools, and show you how they are probably FP&A is the segment I'd put it in, where there is some tremendous value out there in terms of cash flow forecasting accuracy, but also business agility and the ability to really dial in on scenario analysis, react in real time. And so there's some really exciting things going on in that space. And then as far as where you get the data, most times APAR, it's an ERP, or could be a data warehouse. Those of you, the actuals, you can get them from the GL, Subledger, online banking systems, TMS, service providers, or bank statements. So one of the things you want to do when you're doing that assessment is you want to look at, okay, the data, where am I getting the data? Why am I getting it there? Is it timely? Is there a way to automate that? Where do I need this data to go? Where is it needed? How do I get it there? And then data relative to endogenous variables that can drive cash flow forecasting can come from your TMS, FX partners, banks, and sometimes now we're seeing some of the TMS and FP&A, BI, CPM solution providers provide information on variables that may be endogenous as well. When I was back in Treasury, we did not have the wealth of information. What's going on now is more and more companies are putting information into the TMS systems. They're aggregating the information, and they're offering the business intelligence that they gather to those that use their solution. So it's pretty interesting time. In terms of reporting and metrics, some of the reports, first of all, I want to stress you would want to have a standardized reporting packages, could consist of a rolling monthly forecast, daily, weekly, sometimes real-time views. You can look at current month, quarter month, and then we talked about that variance analysis, forecast versus actuals, forecast versus forecast, and then forecast scenarios. And I'll show you a little bit later in the presentation. I'll show you two different scenarios from a cash flow forecasting perspective, based on tweaking one of the drivers. In terms of metrics, again, we mentioned earlier, metrics are important. We want to have KPIs related to key cash flow drivers so we can make sure those involved in our process have those incentives to give us an accurate forecast, and we need to reward them and in some sense punish them. We also need to give those folks the tools and technology and training that they need in order to deliver us the information that we need. And so one of the areas that I think doesn't get enough attention when I see cash forecasting related presentations is the accuracy piece. And so I just wanted to share some of the slides with you. I'm not going to read through the slides. I just like to have some sort of Greek symbol in all of my presentations. So mean absolute deviation is a measure that you can use. Just a tweak on that, mean absolute percentage deviation. And then a couple other ones, cumulative forecast errors, actuals versus forecasted values, and then average forecast errors. And then I have another reference to a online course which goes much deeper into the value and the accuracy and the value derived from having accuracy and the value to finance. So that would be another great resource. But again, sometimes I bring up the All right, so hopefully you can hear. Sorry about that. Modern technology, right? It can do everything except for get us audio. So now let's take a look back in that cash flow forecasting resource assessment. Again, um, where you're at. This will tell us where we're at, and then after that, what we'll look at is are we leveraging what we have to its fullest ability. So, what are the inherent barriers that we can mitigate and potentially eliminate without much investment in terms of dollars and having to go out and ask maybe our CFO. So that's important. So again, keeping it simple, people, process, technology. Which colleagues directly contribute to or affect cash flow forecasting and its accuracy? Again, we looked at the behavior model, all those folks that are those owners of the drivers. Technology, which systems are used to provide input and output? Again, you may have disparate systems, ERP systems, Excel, ERP modules, BI solution, cloud-based ERP solution, and then you want to look at the processes, which ancillary procedures and policies are going to be involved in defining the cash flow forecasting process. And really, the note on process is that sometimes processes, in addition to being inefficient, really compete with each other. So really looking at the processes below below those cash flow drivers is really something that I've talked about more than a few times. So you want to look at where are you at in terms of people, technology, process. So with my current state of people, process, and technology, what resources do I have now? Then you can start to look at, okay, in terms of these resources, how can I better optimize those resources as well? And then we can look at how we go about filling the gaps that we have in those resources that are going to allow us to achieve success. So let's start with some inherent barriers. Again, some of these seem obvious, but I think sometimes taking that step back can really get you to really, when you look at things, you can say, people, yeah, that, yep, yeah, you kind of shake your head, yeah, that happens at my company, yeah, that happens. And then you can think about how to, how to mitigate these things. And a lot of times, especially with people, there's not a cost involved. It's just you have to play Dr. Phil a little bit sometimes. Individuals who affect forecasting accuracy, they don't understand or they don't care. Obviously, that's a detriment. And so sometimes they don't understand. You can fix that. If they don't care, we can give those folks hard and soft incentives. Lack of internal support from executives, that can be an inherent barrier as well. So that's kind of a key. So if you have stakeholders below, VP of HR needs to understand that the CEO cares that he's contributing to the forecast accuracy, and then but then you can also, it helps to show them how, okay, you give me better forecast, in HR. So this helps me in HR. How, right? How does that help me in HR? Well, it helps me know my expenses. Now I'm going to be able to spend more money in recruiting. I'm going to be able to invest in systems. So you got to take it back to them, how they're benefiting the company, and then how it can benefit their department as well. Um, we have people involved in the process that don't play nicely with each other, either across departments or within departments. Again, like it or not, folks, you have to play Dr. Phil. What you'll see in all the CFO research that you see this year in the last 2 or 3 years are people need to lead across the enterprise, within and across the enterprise. So we all need to get out of the office and really dig in and really mitigate these potential issues. Again, I mentioned some of these for process. Some by design, they facilitate reporting or inaccurate data. They compete against each other, and then even part of the process, you can have people, and one part of the process depends on the other part, and people do not get along with each other. So these things kind of have some crossover effects. And so let's go ahead and look at our next polling question before we start talking about dig into technology. So asking you to share with us the primary technology you use for cash forecasting. Again, everyone who's interested in FP&A or CTP credit, I'm going to need you to answer all of our polling questions here today. Another reminder, we can still take your questions in the questions area of your GoToWebinar control panel. We will do our best to get to your questions during the Q&A session for the time we have left. So in order to be mindful of our time, I'm going to go ahead and close the poll and share the results and share. And I'm a little bit surprised that we have that high of a percentage in Excel, which I guess that we said earlier is the vast majority of folks. So amazing, Excel 82%. So as we start to go through the technology piece and the technology that's out there, I hope you'll see the incentives to take a look at the benefits to be from upgrading from Excel. So thank you very much, everyone, for answering that polling question for me. So what are the inherent barriers? Again, some of these are, you can, those of you in Excel, you can identify with these. Don't communicate with each other or facilitate communication among relevant parties. More than one version of the truth. Access to no system that allows direct collaboration between parties affecting forecasting accuracy. Communication barriers. Doesn't support data needs in terms of timeliness and accuracy. Passing data back and forth, making tweaks. Scenario analysis is really a pain point there. In scenario analysis, I'll show a few research results, which was actually stunning to me in terms of the ability to do scenario analysis, which really takes that value to the next level. So again, just some ancillary data on technological immaturity from the FP&A Empowerment Survey, which I helped put together. And then if you look at reporting and analytical tools, 40% just were using Excel and basic ERP modules for that FP&A. So some of you that are Excel, it would be interesting for you to have a conversation and see what kind of tools your FP&A team is using. In terms of the reporting and analytical tools, that may be something that you may be able to leverage in improving your cash forecasting. So that'd be a great conversation to have. And here is the shocker to me. Ease of scenario analysis, somewhat easy or easy, 10%. And so that's really detrimental to our business agility, and it also speaks to that scenario analysis would really translate back to the ability to the how long it takes us to do that forecast. If we look at our survey results from the FP&A survey, frequency, we had 35% quarterly and 42% monthly and 1% daily. I would have expected this to be a little bit higher, and here's what I find a little disturbing, but that may be the reason for the great audience that we have today in terms of numbers. The not good, 14%, useless. So over 16% useless. Okay, but you need to improve. So that's 60% here. 39% good and getting better, and great, just what we need. But I would say if you're some of the folks that might be here good and getting better, I think that there might be an over optimistically view here in terms if they really understood what could be accomplished if they were to upgrade on the technology side, how much more value that they could be extracted. Just a real high overview again for the technology. We've talked about Excel. One of the things about the ERP system, they really have in general inflexible cash flow functionality, and this just on the cost side, implementation and your modeling can be a little painful. And then just some of the BPM solutions can be expensive. They can be require IT support and take some time on the implementation side. So again, that where you and then cash flow point systems, I'd say that's maybe more of a alignment with a TMS, but they're not integrated for financial planning and forecasting, and this creates a disconnect between operational planning activities, operational and high-level planning activities, and then insight and visibility into the underlying components of cash flow reporting is just difficult to maintain. So. And then we have kind of at the spectrum, which I'll talk about here in a little more detail, is automated planning and forecasting solutions. They provide support for purpose-built cash flow reporting and analysis, automatic dynamic links between key financial statements. Someone asked a question on that front. So there are dynamic links between the financial statements. Some of the leading solutions out there maintain the functionality of your GL and those relationships so that financial intelligence is in some sense programmed in to your system. So when you make changes, the impacts automatically flow through. Support for versioning, drill down capabilities, and that data synchronization is key. And so just some of the features that I talked about, touched on a little bit. There's systems out there that can directly integrate with your GL, mirror your chart of account, built-in rules, logic that function in the same way as your GL. So function of your GL, just really being able to take that intelligence in your GL between the relationships and then the financial statements and get that and export that business intelligence, what you'd expect from a general ledger. So of how all the debits and credits with a transaction would impact the balance sheet or cash flow are automatically calculated for you. So what I see from my Treasury perspective and forecasting experience is just the ability to do that scenario analysis, understand those drivers, which are key. Understand those drivers, what's driving things, keep that intelligence there. What are the things you might want to look at? Again, built-in logic understands the debit and credit implications of every transactions. And so again, that's a big thing missing on the spreadsheet side. So we just take a look at the business accrual here really quickly, and then we look here P&L and expense, and you can see all the accounts that are impacted. And then just real quickly, we start to look at the intelligence that you can put in here. So let's just take a quick look at our telephone, cell phone expense. We look at how that's done, the different options here. So here's what the cash looks like in that case. We can do a real quick analysis here, change that from 30 to 60. We can immediately see the impact. I'm sorry, I'll give you the slides real quick so you can see that there's a change. So there's that automatic impact. So you can see what those assumptions, how those assumptions change. You can drill down on these assumptions. And so the robustness of the impacts in determining the drivers and things that driving, and look at just down to the granular level, the assumptions and things, how those flow to the financial statements is really impressive. And then a robust scenario analysis that impacts your business agility. So one of the things that I've done here is I've put side by side. You can look at alternative scenarios and see line by line the impact on your cash flow statements. So you have your cash flow statement estimate here. You change assumption, a driver, you can see what that impact is immediately going to be. Your CEO calls up and says, one of these drivers, hey, we're going to change sales by whatever. How's that going to? Can we afford? What's going to be that cash flow impact? What is that going to do? And so just some of the value of the information that you have, just the best way to use it, and that technology really unlocks that strategic value. Just wanted to show you real quick, the screenshots here. So we looked at our drivers, expenses, revenue, workforce. This is just what I talked about. Here's our folks' expenses, right? Here's our accounts payable folks, accounts receivable folks. Here's our HR folks. Look, we can look at the drivers there. We can monitor the drivers. We can tweak the drivers. We can see which drivers matter. So this would just be a click shot from the expenses. We can go down here. We can look at that. So we can bookings unit, boom, we can drive down in there, see what's driving that, change those, fiscal year, round. So really visibility and financial intelligence it really allows companies to leverage the right drivers to optimize their value of cash flow forecasting efforts. So really things that are out there, really impressive. Your business case in some sense, the ROI, accurately and timely insight on actual plan, cash values and position. Better information that you're getting is data-driven, impactful decisions, again, beyond Treasury, across the enterprise, collaborating with FP&A, a stronger relationship with your organization's plan and forecast strategy, improved reporting analysis. You see this really powerful against plan, forecast, prior period, quicker decisions. And again, as we saw in the research results, and I've done other webinars to see if that was an aberration in my results, but the big issue I think that some companies have is how hard it is to do scenario analysis and do it right and keep those the business logic and financial intelligence. That's really what's holding companies back in terms of realizing the value of forecasting done right. Now let's pivot back, rewind. How do you perform that gap analysis? Okay, people, again, people, process, technology. Who do you need to get on board? Redeploy to get you where you want to be. Process, what policies and procedures do you need to revise? And then technology, what systems you need to communicate better? Do you need access to new software, upgrades, etc.? So you look at the right technology. Okay, what is holding you back? Right? I think I've shown you the possibilities. What's holding you back from getting there? What do you need? What do you need to get there? Is it a step by step? Or are you going to make the business case in conjunction with your FP&A team and say, hey, this FP&A system is tremendously valuable for forecasting and FP&A. So it's an easy win-win, and we can show the value there really easily. Just a few forecasting best practices from our friends at AFP. So I'll let you take a look at these at your leisure. And of course, I'm happy to send you the presentation. Some of these, again, seem simple. Success, communication across shareholders. You need to focus on collect and analyze data that matters for those key drivers. Efficiency and automation everywhere, all the time. Look for that. Identify key stakeholders, know your goal, automation, reconcile your forecast, stress test, continuous improvement, and work with business all across your business to understand the connections to cash. So just putting a fine point on some of the content that I covered, understand correlating relationships, assumptions, technology, and it's got to be usable. And so connecting you with the resources, again, I couldn't answer all your questions today. Hopefully I can help you ask the right questions, connect with the right people. We have LinkedIn management groups. Connect with your fellow cash forecasting practitioners. There's intensive seminars on forecasting mechanics, presentations, white papers, a few of these I've referenced, AFP. Go to your bank partners, TMS providers, Treasury consulting firms. There's so much out there. On-demand courses, on-demand resources to help you assess where you are, where you want to be, and how you're going to get there. So, in closing, cash flow forecasting success. Sorry, I'm reading off the slides a little bit, a lot of content. Clearly understand the purpose of your forecast. Define your goals. Understand your data, sources and factors that impact accuracy. Identify and understand the sources of variance, and focus on the sources you can control. Assess your resources you need, and identify current inherent barriers, mitigate those, perform that gap analysis, build the business case for accuracy, and sell it. And identify professional colleagues who face your same challenges and engage them in LinkedIn. However you do that, LinkedIn is a great way to do it, AFP conferences. So all these things are key to cash flow forecasting success. A lot of content to cover, so unfortunately, I'm not going to be able to get to your questions today. I'm going to be happy to follow up with you afterwards with any questions I didn't get to. One more final polling question, kind of a fun question. If you had $100,000 and to use it to increase the value of cash forecasting, how would you use those funds? So I'm going to go ahead and leave our polling question up for another 10 seconds or so. So I would like to once again thank our sponsor, Senage, whose strong commitment to thought leadership helps us make this webinar possible today. In the survey after the webinar is over, you'll be asked if you'd like to be connected with our survey sponsor and learn more about how they are helping companies optimize the strategic value of their forecasting and FP&A efforts. And finally, to you, the audience, thank you very much for your valuable time today. Make the rest of your day great, everyone.